I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thanks so much for joining me.
It's my pleasure to be here.
We are here right now at the Denver Gold Forum. How is the mood feeling to you right now? What's your sense of how people feel about the gold space right now?
Well, the problem, I think, with forums on gold mining is that you get this self-perpetuating optimism. So these guys come, and even if the market is in bad shape, they want to believe that it's going to get better. And by talking to each other, they sort of convince each other that, the collective wisdom must be right, that things are going to go up. So there's a fair bit of optimism here right now.
Are you feeling like that's justified or not so much right now?
Well, that's the ironic thing is I actually do think it's justified. I don't expect the gold price to rise sharply soon, but I do expect it to start rising within the next 6 months or so. And I do envision radically higher gold prices at some point over the next 8 years, simply because I think the economic and political environment will require it.
Do you have any exact prices to go along with those timelines?
We wouldn't be surprised to see the price of gold back into the $1,250, $1,280 range by the end of this year. We would expect it to be in the $1,280 to $1,340 range by late 2019. And then at some point, probably around 2023, 2025, we wouldn't be surprised to see record gold prices of $1,800, $1,900, maybe even $2,000 an ounce.
What would be driving those price increases?
Well, there are a variety of factors driving them. The biggest factor determining gold prices is investment demand. And if you go back to, say, 2008, 9, 10, 11, when the gold price went from $800 to $1,900, what was driving gold prices higher was investors went from buying 20 million ounces of gold to 30, then 40 million ounces of gold, physical gold in a given year. And now, after that, 2013, 14, 15, they were buying about 17, 18 million ounces. They're buying around 20 million ounces again now. We think that the economic and political environment will turn hostile to traditional assets going forward, and that by 2023, and maybe sooner, you just don't know when these things come home to roost, we'll see a period of hostile economic conditions, similar to what we saw in 2008, 2009, which will drive investors to buy 30 or 40 million ounces. The gold market itself, meanwhile, is not really geared up to supply that extra 10 or 20 million ounces. It's not there. So the only way that investors can get that extra 10 or 20 million ounces a year is to bid the price up so that people who bought at lower prices will sell them their gold for profit.
Okay, and you'll be giving a keynote presentation tomorrow on stimulating central bank and investor demand for gold. I imagine it's going to cover some of those themes. So for those who might not be aware, what does the central bank buying landscape look like right now?
Yeah. Well, central banks were net sellers of gold from like 1971, actually 1967 until about 2008. And that was gold that they had built up during the gold dollar standard period. They turned net buyers in 2008, 2009, but if you look at it, it's primarily been Russia, China, and Kazakhstan that have been buying. Other central banks haven't been major buyers. The point that we're going to make is that you have some central banks, one notable one that's been very public is the Central Bank of Turkey, that are not just using gold as a sterile monetary reserve in the basement, but rather also using it for monetary policy purposes. And one of the points that the point that we will make about central banks tomorrow is that if you want central banks to buy more gold, they need to know that they can use gold in monetary policies and it's not just a sterile asset. Because if a central bank is using the gold, as Central Bank of Turkey is or the Bank of International Settlements, they will be more likely to buy more gold.
So does there need to be some education there, and who would that come from?
Well, that's one of the key points. There needs to be some education there, but gold producers in the gold industry are ill-suited to provide that and the gold promotion agencies that the gold industry finances really don't understand why central banks or investors or even jewelers buy gold and how they use it. And so the education needs to be to be disseminated, but the gold industry isn't really the suitable source. So the education really should come from the IMF and the World Bank, with whom we work.
Okay, so you will be presenting a solution to that.
Yes.
Yes, okay. How would you say for individual investors, is there a specific way you would say they should allocate gold in their portfolios?
Right. Well, that's the main part of my
Okay.
presentation tomorrow, and it's a similar theme. There are actually three themes to my presentation. One is how do you get central banks to buy more gold? One is how do you get investors to buy more gold? And again, if you look at investors, I've known a lot of investors who have lost incredible amounts of money investing in gold. And I've known a lot of investors who have made incredible amounts of money investing in gold. And if I analyze what the guys who made the money do right, is they think of gold properly. They think of gold as having several quite distinct functions as an investment and a financial asset. So they'll hold some gold as a long-term form of insurance and portfolio diversifier and currency wealth denominator diversifier and currency diversifier and insurance policy. But they'll also own some gold that they trade back and forth so that they can take advantage of shorter term moves. I tell the story about an investor that we were working with who started buying a lot of gold in late 2007 when the price was about $750 an ounce, and then it went to $800 and $900. And then when Bear Stearns went bust in March of 2008, it shot up to $1,000. And he said, do we keep buying? I said, no, stop buying, wait for it to fall to $900, and buy some puts at $900. He said, well, what if it keeps rising? I said, don't worry about it. And so he bought these puts. The price, in fact, fell down to about $880. He made about $100 or $120 an ounce on his puts, and then he started buying gold again at his target price. So instead of buying gold at $880, his effective acquisition price was like $780. And if you buy gold in a reasonable basis as an investment, not as a true believer who thinks that gold is a secure source of constant purchasing power and stuff like that. If you buy gold as an investment and you buy it and you take profits and then you buy it again and then you take profits, you'll do a lot better.
So again, that education theme. Okay, last question. We've been talking about gold. This is a gold conference, but you're very knowledgeable about other precious metals as well. Mm-hmm. Which one would you say has the most potential as we move into the end of the year, into 2019?
I think gold is the most attractive for price appreciation through the rest of this year and through 2019. I think silver, even platinum and palladium have upside potential, but I think that gold will outperform.
Thanks very much. That's all from me. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.